Okay, our special guest Robert Parker joins us live from London, advisor at Credit Suisse. Robert, thanks for joining us on the show. We had an audio problem, but hopefully we fixed that. First up, your view on how FIRs are likely to read the government's move to actually defer the applicability of GAAR by a year.
Sorry, the line is really bad. I can't hear you.
Robert, I was asking you if how do you think FIRs will read into the government's move of deferring the applicability of GAAR by a year? Do you think it's a big positive from an FIR point of view?
Yeah, if I understood correctly, the question was about the delay in the GAAR. I think as we discussed at the time of the Indian budget, one key issue in the Indian fiscal situation is to expand the fiscal base in India. And obviously part of that is to improve the efficiency of tax collection and to minimize tax avoidance. Now, perhaps the tax authorities, the fiscal authorities in India are not prepared to administer the GAAR yet, and therefore you could argue that the delay means that they can then implement it more efficiently in 1 year's time. Having said that, I think actually the impact on the markets short term will be fairly minor, although I would encourage India obviously to implement GAAR as soon as possible. Any delay is obviously not satisfactory.
So, Robert, what do you think the central bank is going to do at a time like this? Inflation is still pretty much a big issue at this point in time. The Reserve Bank, in its last commentary in the credit policy, has pretty much indicated that they don't have enough headroom to cut rates any further. How do you think the central bank action is going to pan out in the due course of time?
Well, obviously, the RBI has a number of challenges. The first challenge is that, yes, the inflation numbers are slowly coming down, but the pace at which inflation is coming down is exceptionally slow. We have negative real interest rates in India. I think that is positive for growth. And obviously one challenge for India over the balance of 2012 is to get those growth numbers back above 7% on an annualized basis. And by the way, on that, one encouraging note obviously was the April PMI for manufacturing, well above 54. And the improvement in the purchasing managers' indices, I think, does give one some confidence that the growth numbers should improve. Two drivers for growth, obviously the weakness in the currency, that's bad for inflation, but it now puts Indian exports, which were suffering earlier in the year and late last year from too strong a currency, exports should now benefit from currency weakness. Having said that, I think the RBI is now constrained, at least for the next 3 interest rates further. It does have to be careful that its action in running negative real interest rates does not lead to a further upturn in inflation, and obviously that would be unwelcome.
Right, Robert, you spoke about the rupee, but from an equity market point of view, a weakening rupee isn't really great news, and we've seen some pressure in the equity markets on account of the weak rupee. What is your view on that? How much of a concern is that?
Well, on the Indian rupee, I think the analysis is fairly straightforward, which is that India suffers from a trade deficit. That means that India, to achieve currency stability, is reliant on capital flows. Earlier in the year, January, February, we saw strong capital inflows. Those capital inflows obviously have stopped over the last 6 weeks or so. And the consequence has been a weaker currency. The currency now technically is oversold at around 53. I would argue that the currency is now undervalued. And consequently, I don't see a return to currency strength given the need to encourage capital inflows. And also, I think the driver at the moment obviously is negative real interest rates. And negative real interest rates theoretically lead to currency weakness. So after this sell-off that we've seen, really since March, my view is currency stability in the short term. But for the currency to re-strengthen, obviously we have to see a return in capital inflow.
So, Robert, what is it that you're penciling in by way of a Q1 GDP figure, as well as what we can expect from the industrial production numbers this time around? Because time and again, they've been the real shocker for equities.
Well, the industrial production numbers are, the market consensus is that we're going to get a weakish number. Having said that, as we go into June, July, August, I am assuming that the industrial production numbers after this patch of weakness will improve, driven by a lower interest rate policy and driven by a weaker currency. So I think that this patch of economic weakness, which, by the way, has not been just a case for India, if one looks at other major emerging markets, one shouldn't forget that the Brazilian economy stalled at the end of last year and the beginning of this year. Obviously, there has been a lot of concern about a Chinese hard landing. So, that emerging market economic strength theme in investment markets obviously is now looking more questionable. Having said that, I come back to my earlier point of stronger India PMIs. Consequently, I think that we will see, come June onwards, better GDP numbers and better industrial production numbers.
Right. Robert, from an equity market point of view, what is it that you think could be a trigger for a rally, or that you think could bring in more FII flows? Do you think the government now needs to move forward quickly on reforms for any sort of meaningful participation from FIIs?
Well, clearly India was one of the best equity performing markets at the beginning of this year, and in fact at the beginning of March. The year-to-date performance of the Indian equity market at one stage was up 18% on a year-to-date basis. Obviously, recently, a major part of those gains has been given up. Year-to-date, the performance of the Sensex 30, we are up about 8.5% year-to-date. That means that India is now underperforming China year-to-date. I think one interesting observation is that in January and February, the valuation of the Indian market was relatively expensive compared to markets like China and Brazil. That valuation difference, which was a negative for the Indian market, but notably in March, I think is now starting to look less negative for India. I think the key question is, should global investors take any setback in the Indian market as a buying opportunity, or is this the start of a trend bear market? My view is that, and this has always been my view, that the second quarter was going to be a difficult period for the Indian market against a quite negative global backdrop for global equity markets. I take the view still that come late June, early July, we will probably see a base being formed for the Indian market for a recovery in the second half of the year. And, negative real interest rates are theoretically positive for the market. If we get stability in the currency at this level, i.e. we don't get another major sell-off, I think that would be positive for the market and would attract foreign investment. And coming back to our earlier point, if we do get, as I expect, some improvement in the growth and the industrial production numbers, I think that would be a strong positive for both domestic and international investor confidence.
Robert, how critical is the situation in Europe right now with Holland's win in France, there's a bigger question, or rather fear in the market as to what is going to happen to policies right now and whether or not he's going to be able to tighten regulations from here onwards.
Sorry, I didn't quite catch that. Could you just summarize that question, please?
Sure. I was talking about the critical situation in Europe right now, post the French elections. What is it that we can see on the policy front and tighter regulations in Europe?
Well, I think if I understood the question correctly, I think the global equity economic backdrop at the moment is somewhat problematic. We've got a growth slowdown from 2 to 2.5% towards 2 to 2.5% growth in the States. We have clearly serious political problems in Europe. Japan, the economy is stalling at around plus or minus 1.5% growth. Having said that, I do think the global equity markets will improve in the second half of the year. I think that backdrop will be positive for the Indian market. And coming back to my earlier point about valuations, most equity markets are very undervalued relative to history at the moment, and that drag on the Indian market from an elevated relative valuation at the end of the last year is obviously correcting as we talk.
Robert, just to pick on the point that Aisha was just making a little while ago, the situation in Europe, especially in light of the political changes that we're seeing, specifically in France with François Hollande taking charge there, you would not be too worried, and more importantly, what kind of an impact could that have on fund allocation to emerging markets like India?
The line's very bad, but if I understood correctly, it was a question on sort of sector analysis. And, globally, and this comment applies to India as well, we like defensive sectors at the moment. Later in the year, we may well move back into cyclical sectors. One obvious comment on the Indian market is that with this weakness in the rupee, with it trading plus or minus 53, that will benefit the export sector and particularly the technology sector. And one global observation is, as you well know, we have been long the technology sector since March 2009. I see no reason to reverse that long position in global technology. I think another observation is that if Indian growth returns in the second half of the year to 7% plus, then that clearly is positive for the consumer sector. Although one observation I would make on foreign investment is clearly the decision by the government to restrict foreign investment in the retail sector was not positive.